this time last year, around November 2021, you'll recall there were headlines, bare shelves, empty shelves, supply chain breakdown, Christmas will be canceled, etc. And it was all true. You went to the supermarket. It didn't mean that every shelf was completely bare, like East Germany in the 1950s. But there were, paper goods might not be there, or maybe your favorite kind of tomato sauce, or chicken, or whatever it was. There were some things there, but a lot of things weren't there, and that got worse. And then, of course, gas prices skyrocketed basically because of a lot of bad policy from the United States in terms of Keystone Pipeline and a lot of other factors. That then got worse. It eased up a little bit in the summer, but it never went away. This is a complex system. It was breaking down. That was very clear. And now we're seeing a second wave of that. I don't want to overuse metaphors, but one metaphor is you have a very beautiful, expensive vase, and somebody knocks it over and it breaks into 5,000 pieces. You can't put the vase back together. You've got to go get a new one. And that's what's happened with the supply chain. What I call supply chain 1.0 from 1989 to 2019 is broken. There will be a new supply chain. There always are. Supply chains have been around since the Bronze Age, if not earlier. But the new supply chain, what I call supply chain 2.0, will look very different than the old supply chain. Right now, we're in an in-between period where things don't work well. Again, it doesn't mean total chaos, but you still see shortages, you still see higher prices, which are coming from supply chain disruptions. And these things are not easy to fix. A lot of people say, well, COVID came along, of course it messed up the supply chain. The supply chain was breaking down before COVID. Now, of course, COVID made it worse, yes. And the war in Ukraine made it worse yet, yes. But this really started with Trump's trade war in 2018. So that, like I said, there's a thread that runs through all these things. So not to throw out my hands, I'm not going to do that. But when you ask me that, I'm thinking, well, talk about China, Ukraine, supply chain, Biden, they're all a big deal. If in terms of tragedy, probably the war in Ukraine is the most important because it's highly, highly significant economically and strategically, but of course, it's a human tragedy going with it. If Chinese real estate implodes, okay, there's some hardship here and there, but it's not like people being killed or maimed or forced into refugee status, and that is part of what's going on in Ukraine. So that's probably the biggest single one, but I wouldn't miss the fact that all these things are going on at once. So what happened between 1989 and 2019? Well, beginning in 89, you had the fall of the Berlin Wall. 1991, the demise of the Soviet Union. 1992, Deng Xiaoping's Southern Tour, which is when China really came into the global economy. Yeah, they had some good growth in the 80s, but the Tiananmen Square set them back, and then there was a hiatus, and then 1992 they came back on stream. So all of a sudden, it wasn't just international trading. So all of a sudden, your supply chains went from Chongqing to New York, or from Shanghai to Amsterdam. These were 9,000, 10,000 mile supply chains. And the more you stretch the supply chain, the more things that can go wrong. Now, why did everyone do this? And also there's, around that time, increased computing power, artificial intelligence, better applied mathematics, and more data gathering created supply chain science. I make the point, supply chain has been around since the Bronze Age, but supply chain science was relatively new. It was all driven by efficiency. Lower cost, lower cost, lower cost, kind of the Walmart model. If we're on the verge of a global liquidity crisis, as revealed by the Euro-dollar futures curve and the Treasury yield curve, and negative swap spreads and Treasury bill auctions with yield to maturity below what the Fed will give you for a phone call, all those things are happening. That's hard data, and it's a very, very troubling sign. Last seen in 2008, by the way, before the Lehman Brothers meltdown. If all that's happening, and the fundamental signs are also weak, which we just saw in third quarter GDP, which is based on net exports, which won't last. How are you going to drive a trade surplus with the strongest dollar in 20 years? Good luck with that. Nobody can afford our stuff, and we're not buying anybody else's stuff. When you say we're putting up inflation numbers today that are the highest in 40 years, that is correct. A little 41, actually it was 1981 before we saw these numbers. But I remind people, the inflation in 1981 was the end of a 10-year period of inflation. It wasn't the beginning. It's like, oh, that's some inflation. Yeah, we did, but it had started. I mean, some ways it started in 1968 and it really took off in 1974, 75. So 81, these numbers, that was when Volcker finally got it under control. Between 77 and 81, so that 5-year period, the dollar lost 50% of its purchasing power, not 15, 50 in that 5-year stretch. So you were putting up numbers, 10%, 11%, 13% and higher year after year. Yeah, 1981, it was 9 or 10, which is what they're comparing it to today. But that was on the downslope. It had been higher than that in 77, 78, and 79. So the question is this the beginning of an inflationary surge where it's going to get even worse and it's going to last 5 years, or is it different than that? But keep that in mind, because the 40-year comparison, it is correct, but that was the tail end of an even worse episode. The standard definition of a recession is 2 consecutive quarters of declining GDP. There are a few more bells and whistles having to do with unemployment and a few other things, but that's the rule of thumb. So based on that, based on the best available estimate for a second quarter, likely to be accurate, we're in a recession today. When you stretch things that far and have that many inputs and that many things that can go wrong, you've created a very fragile system. And now we're seeing the hidden costs come to light to break down. So what does the new supply chain look like? A couple of things. I see the creation of what I call a college of nations, basically a group of like-minded countries that will continue to trade with each other, will rely on each other for outsourcing, but it won't be everybody. It'll be like a club, and it'll be, the liberal, democratic, good rule of law societies that respect human rights. So United States, Canada, Australia, Japan, New Zealand, Western Europe, and then there'll be some other countries that will be in the club, India, Brazil, and a few others. And they'll trade with each other and build factories in each other's countries. So you'll still have supply chains, but it'll be much more compact. China will be completely decoupled. And by the way, that's a mutual view. The US is decoupling from China, but China wants to decouple from the United States just as badly. So China's going to be out of this college of nations, as I describe it. They're going to have to form their own club. So what you're going to end up with is, will countries trade with each other? Yes, but it'll look more like the 1950s and 1960s, where you have like-minded countries. You're either in the club or not in the club, but the US and China are going to be running 2 different clubs, because that has implications for economic growth, currencies, direct foreign investment, and so forth. But it's going to evolve that way. It's happening already.